Welcome to Talk Tickers. We cut through the noise of earnings calls to give you the essential insights.
That's the plan?
Today, we're diving into SSNC Technologies' first quarter 2025 results.
Right, SSNC.
In short, they reported pretty solid growth in revenue and earnings.
Yeah, look pretty good overall.
Driven significantly, it seems, by their GlobeOp division and progress in key strategic areas.
Like Australia and AI, yeah.
Exactly, like the Australian superannuation market and their AI initiative. So let's unpack the details.
Okay, let's do it. The headline numbers, well, they paint a picture of a healthy business.
Mm-hmm.
Adjusted revenue reached $1.5148 billion. That's a 5.5% increase compared to last year.
Okay, 5.5% up.
And earnings? Their adjusted diluted earnings per share also saw a strong uptick, hit a $1.44.
$1.44.
Which is an 8.3% rise year over year. So decent growth there, too.
And that translated to robust profitability, right? The EBITDA.
Absolutely. Adjusted consolidated EBITDA came in at $591.9 million.
Okay.
That's up 6.3%, resulting in a very healthy margin of 39.1%.
Almost 40%. That's strong.
Yeah, really strong. And looking at their core performance, adjusted organic revenue growth was a solid 5.1%.
Right, 5.1% organic. That's, a good underlying indicator.
It is. It shows fundamental demand for their services.
Mm-hmm.
But what really jumps out, I think, is the exceptional performance of GlobeOp.
Ah, yes,
It achieved an impressive 10.3% in organic growth.
Wow, double digits.
Yeah, clearly a major engine for them in the first quarter.
So what's driving GlobeOp so much?
Well, this outperformance suggests, strong alignment with current investor appetite for non-traditional assets, private markets, alternatives.
Right.
And their focus on the Middle East expansion, that also seems key. It indicates a proactive approach to emerging pools of capital.
So they're not just relying on the usual markets.
Exactly. Could give them a significant edge over competitors still maybe focused on more traditional markets.
GlobeOp's numbers are certainly eye-catching. It seems their strength in private markets specifically, that grew 14%.
Yeah, 14% growth in private markets.
Yeah.
And like we said, their expansion into retail alternatives, particularly in the Middle East.
Seems that deliberate push is really paying off.
It looks like it. And beyond GlobeOp, the financial services segment also showed a pretty solid foundation.
Okay.
A 5.9% recurring revenue growth rate there.
Almost 6%. That's good for stability.
Definitely.
Huh.
It highlights the stickiness of their client base, and the predictable nature of a big chunk of their earnings.
Gives them a reliable base for future earnings, suggests strong client retention too.
Right. And maybe even some pricing power within those relationships.
That recurring revenue definitely provides stability. We also saw a significant jump in their cash generation, didn't we?
We did. Cash from operating activities increased by a substantial 50.8%.
50.8%. That's huge.
Yeah, up to $272.2 million. That surge really speaks to improved efficiency and the earnings growth flowing through.
In the conversion rate.
Improved significantly. A conversion rate of 74% means a good chunk of their earnings are turning into actual cash.
Which gives them options.
Exactly. More options for reinvestment, acquisitions, or more share buybacks. Shows pretty strong financial health.
And speaking of buybacks, they put some of that cash to work there, right?
They did. Repurchased 2.4 million of their own shares.
Okay.
For about $206.9 million.
Okay.
Seems like a statement of confidence in their own stock.
Yeah, especially backed by that increased cash flow.
Exactly. So looking beyond GlobeOp, their wealth and investment technology segment also continued to perform well.
Wealth management still strong then.
Seems so. And their global investor and distribution services business also met its targets, apparently.
So it looks like most parts of the business are contributing positively. What about any areas that saw slower growth?
Well, their health business, management seems optimistic about its potential, but it was roughly flat in Q1.
Flat, okay.
It's a big market. Sales cycles can be long, variable, so something to keep an eye on going forward.
Definitely. Any other highlights? International.
Yeah, internationally, Australia's superannuation market is proving to be a real bright spot.
Ah, the wall of money.
Yeah, they actually referred to it like that.
Yeah.
Shows the scale of the opportunity, right?
Absolutely.
They seem to be leveraging their tech advantages there to win new clients. And also their Geneva business had a strong quarter in EMEA. Won several significant deals there too.
So traction in Europe, Middle East, Africa as well. Okay.
Yeah.
That Australian superannuation market definitely sounds like a major focus. So beyond these growth areas, what about strategic initiatives? What are they focused on for the future?
Okay, well, a key one is that strategic lift-out agreement with Insignia Financial.
Right, the lift out.
It's apparently on track for implementation around July 1st.
So start of Q3.
Pretty much. This basically means SS&C takes over a specific part of Insignia's operations, revenue, clients, the lot.
And the expected contribution?
Expected to add somewhere between $35 million and $70 million in revenue in the second half of 2025.
Okay, so a decent bump later in the year.
Should be. And they're also, as we mentioned, seeing strong demand and getting more mandates in that Australian superannuation market.
So doubling down where it's working. Makes sense. And the tech side, AI.
Absolutely. Big push there. They launched a global governance-first AI platform.
Governance first. Interesting angle.
Yeah. Signals, they understand the regulatory hurdles in finance, right? Could be a key differentiator, attracting clients who need compliance alongside the tech.
Good point.
And they introduced 20 new AI agents too, designed to handle complex, unstructured content.
Which could mean big efficiency gains for clients.
Potentially, yeah. Also, the integration of Batea, that's their class action claims acquisitions, apparently going well. Got 10 cross-sell customers already.
Early days, but a good sign. So it sounds like AI is key long-term, but maybe not a huge immediate revenue driver.
That's pretty much the picture management painted. They see AI as fundamental, something to strengthen the business and offerings over time.
Makes sense. Any other strategic points?
Their alliance with Morningstar is apparently creating new opportunities in wealth and investment tech.
Okay.
And they're continuing to transition clients to their Genesis platform. Just ongoing operational stuff there.
Got it. Let's circle back to the financials just for a moment. Beyond the headline growth, anything else stand out?
Well, the decrease in their net interest expense was a positive, helped the bottom line, driven by lower short-term rates, apparently.
Okay, a little tailwind there.
Yeah. And as we discussed earlier, that big improvement in cash flow conversion rate to 74% is definitely noteworthy.
Right, strong cash generation.
And they ended the quarter in a solid financial position. $515 million in cash and equivalents.
And leverage.
Net leverage ratio is 2.74 times. Pretty manageable.
Okay. And what about their outlook, their guidance for the rest of 2025? They updated that, didn't they?
Yes, they did. For T2, they're projecting revenue between $1.489 billion and $1.529 billion.
Okay.
Which implies about 2.5% organic revenue growth at the midpoint for the quarter.
A bit lower than Q1's organic.
Yeah, a little cautious, maybe near term. But for the full year, they've modestly increased their revenue guidance.
Oh, okay. By how much?
By $13 million at the midpoint. So now expecting a range of $6.110 billion to $6.238 billion.
And the full year organic growth expectation.
That's now anticipated at 4.4% at the midpoint.
Right. So still expecting a pickup later in the year compared to Q2's forecast.
Exactly. And their full year adjusted diluted EPS guidance was also slightly raised, now between $5.68 and $6.
Okay. Anything else on guidance? Spending? Capital allocation?
Yeah, interestingly, they slightly reduced their capital expenditure plans.
Spending less on CapEx.
Seems so. And they indicated a greater focus on share repurchases compared to further debt reduction.
Interesting shift. Using that cash flow for buybacks more than deleveraging.
Looks that way for now.
So, okay, slight increase in overall expectations for the year, but maybe some near-term caution baked into Q2. What were the main takeaways from, management's tone and commentary on the call?
Yeah, a key theme was definitely the company's resilience, amidst all the global economic uncertainty.
Standard message, but important.
Right. They really emphasize their strategic focus on using AI-driven innovations to help clients transform. That came up a lot.
The AI focus again.
Yep. And they sounded very optimistic, bullish even, about the Australian market, that wall of money.
Can't blame them if the growth is there.
True. They did acknowledge a degree of conservatism in their Q2 organic growth forecast, citing those global uncertainties.
Okay, so they admitted being a bit cautious.
Yeah, but they voiced strong confidence in an acceleration in the back half of the year.
Driven by?
Driven by the Insignia deal kicking in, contracts they've already signed, and the Batea acquisition turning organically accretive.
So known factors expected to drive growth later on.
That's the idea. Management also highlighted a pretty robust demand environment overall. Clients actively looking for tech solutions to, improve processes, get faster access to info.
Standard drivers for their business, really.
Pretty much. They also anticipate continued strong growth in private markets, thinks higher yields will keep attracting assets there.
Makes sense.
And they characterize the hedge fund industry as kind of a stable sector, a safe haven even, seeing continued asset growth during volatility.
Interesting take on hedge funds. Okay, so now here's where we put on our purely hypothetical, definitely not financial advice hats.
Right. The fun part.
Based on our deep dive into this call, what's an outrageous but plausible trade idea that, springs to mind?
Okay, all right. Given SSNC's clear enthusiasm and their success in cracking that Australian superannuation market.
The wall of money market.
Exactly. And just thinking about the sheer size of the assets involved there, here's the thought. Maybe consider a long position in companies providing specialized cybersecurity solutions.
Cybersecurity. Okay, why?
Well, specifically ones tailored to the financial services industry in Australia, as SSNC and others manage more and more sensitive financial data in that huge market.
The need for top-notch security goes way up.
Precisely. The need for robust cybersecurity will only intensify. So these niche cybersecurity firms, they could become attractive acquisition targets for bigger players like SSNC wanting comprehensive solutions.
Or just benefit from the rising tide.
Or just benefit from increased demand for their specialized services in that rapidly growing sector. It's a way to play that specific theme.
An interesting angle. Playing the ecosystem around the big trend. I like it. Okay, that concludes our deep dive into SS&C Technologies' first quarter 2025 earnings call.
Hopefully that gave you a clear, concise understanding of their performance and their outlook.
What are your thoughts on SS&C's big focus on international expansion, particularly Australia and the Middle East? Seems like a key part of their story.
Yeah, definitely. And how do you see their AI offerings evolving? How will that impact their competitive standing, in the next few years?
Good questions. We encourage you, the listener, to keep the conversation going. Share your insights, any further questions you might have. We're always learning from your perspectives.
Absolutely.
Yeah.
And remember, nothing we've discussed today should be considered financial advice. Always. Always do your own thorough research.
Indeed. Join us next time on Talk Tickers as we dissect another important earnings call.